Hello everyone, and welcome to our presentation on IFRS 9. My name is Colin Byer, and I'm here with Max, Jack, Ryan, and Rachel. So we'll begin with our introduction. Now, we'll be going over IFRS 9, kind of giving an overview of the topic as a whole. Then we'll be getting into the classification of financial assets and how IFRS 9 impacts that certain way, as well as the recognition of impairment of financial assets along the same lines. Then we'll get to comparing and contrasting IFRS 9 with FASB standards, kind of giving pros and cons of both. And then we'll get into examples of IFRS 9 in financial statements. And now I'll hand it to Max to get started with that overview.
What is IFRS? The IFRS, or International Financial Reporting Standards, are a reporting standard used to set rules at an international scale that are common to keep financial statements consistent, transparent, and comparable around the world. These standards are issued by IASB, or the International Accounting Standards Board, to help specify how the different companies and organizations should report and maintain their different accounts, define types of transactions, and other events with financial impacts. Though the IFRS is set for international accounting, it is not a universally used way of transactions, as places such as the US use different standards such as GAAP, and other companies will use different methods as well. There are many different factors when determining how financial assets are classified under IFRS. All of these factors determined were aimed to help users understand the financial reporting of financial assets in many ways, such of which include reducing the number of classification categories and providing a clearer way of measuring. In particular ways, financial assets replace numerous categories from the previous ruling of IAS 39. Secondly, applying a single impairment method for all financial assets that were not measured at fair value. And lastly, aligning the measurement of attributes of financial assets with the entity and the way it manages its financial assets and their contractual cash flow characteristics. This provides relevant and useful information to users for their assessment of the amount, timing, and uncertainty of the entity's future cash flows.
I will be talking to you guys about what changes and requirements for reporting are under the IFRS 9. The first major change in reporting is how financial assets are classified. When classifying assets, they are classified by the asset's cash flow characteristics and the entity's business model for that asset. These assets can be classified as either an amortized cost, fair value through other comprehensive income, or fair value through profit or loss. In order to be classified as an amortized cost, the IFRS 9 requires the asset to pass two tests, the contractual cash flow test and the business model assessment. To pass the contractual cash flow test, cash flows must consist of only principal and interest. It cannot be linked to a change in equity because that introduces risks that cannot be held standard by the contract. In order to pass the business model assessment, the financial asset must be expected to not be sold, otherwise it will be classified as a fair value through other comprehensive income. Fair value through other comprehensive income, or FVOCI, is the classification given when the financial assets are expected to collect contractual cash flows and sell financial assets. FVPL, or fair value through profit or loss, is the classification given to any asset that does not qualify as an amortized cost or FVOCI. On this slide is a nice depiction to help you determine how you would classify an asset under the IFRS 9. One other change in reporting requirements is impairment. Under the IFRS 9, impairment is calculated using an expected loss model. This model requires an impairment allowance to be held against the amortized cost of those financial assets that are classified under amortized cost or FVOCI. This change was made to prevent businesses from delaying recognition of asset impairments and forces them to identify potential credit losses sooner. There are three approaches for estimating credit loss: the simplified approach, general approach, and purchased or originated purchase approach. The general approach is the most common and includes 3 stages for determining expected credit loss and how interest income is recognized. There's a great demonstration on the next slide of how this loss is calculated. Rachel is going to talk to you about the differences between the FASB and the IFRS 9.
Hello everyone, and thank you, Ryan. My name is Rachel Save, and I will be discussing the differences between IFRS 9 and FASB. To begin with, I want to start by talking about the old FASB standard for loss. It was called Allowance for Loan and Lease Losses, or ALLL, and it focused on incurred losses. An estimate of uncollectible amounts was used to reduce the book value of loans as a contra account to adjust liabilities. This created a focus on the past as far as credit impairment was concerned. Because of this and the efforts of many countries to create globalized standards, the FASB desired to make a more future-oriented way of looking at these losses. The FASB decided to make a switch to the Current Expected Credit Losses approach, or CECL. CECL focuses on the future and is comparable to IFRS 9 as it relies on expected losses with a prospective approach rather than focusing on past losses. CECL replaced ALLL in 2016 and is set to begin in 2020 or 2021, depending on the specific business type. As I said, CECL is comparable to IFRS 9, however, there are some differences. IFRS 9 uses a contractual cash flow test called the SPPI test. SPPI stands for solely payments of principal and interest. This means that the contractual terms of the financial asset should be only payments of principal and interest, and that financial instruments such as bonds payable, fixed rate loans, and others with set payment amounts would pass that test. However, instruments such as equity investments or bonds where the interest is linked to revenue would fail. Another difference is that IFRS 9 has 3 stages of credit losses. In stage 1, the assets are considered performing. In stage 2, the credit risk has increased significantly since the recognition of the assets. And finally, in stage 3, there is credit impairment. These multiple stages allow for credit losses to reflect the deterioration over time. This helps improve data quality for everyone looking at financial statements. Finally, I would like to talk about one similarity worth mentioning. Both FASB and IFRS 9 allow for companies to choose to use the fair value option, or to apply the fair value option when an asset fails the SPPI test. This change in having both models considering future credit losses is another big step to universal standards all across the world. And with that, I will pass it off to Colin.
Thank you, Rachel. Now, we'll be getting into comparing and contrasting IFRS 9 and FASB standards and giving some advantages and disadvantages to each set of standards. Now, with IFRS 9, obviously the advantages that they have going forward are that they focus more on projections, so the information that investors are getting and that managers are making decisions based off of are more accurate for forecasting the company's financial future. Also, the staging of losses encourages a fairer reporting environment, making it so that there isn't as much of a pressure to perhaps misrepresent something on a financial statement, because there are now clear guidelines as to how these losses can be put on the balance sheet and on the income statement. And then they also have classification tests to make it easier to go about recognizing items properly. So that way there's no gray area between certain assets. If they do or don't meet the test, they're classified a certain way. Now, a disadvantage that does come with IFRS 9 is that it does give companies less flexibility to recognize losses in the current period, because the staging of losses is very staggered and throughout multiple years normally. Companies cannot just make a bulk write-off of certain items that they have on their balance sheet. So if they do have such a catastrophic loss, they still won't be able to claim those losses in the current period. They'll have to stagger them out. Now, moving on to FASB. Some advantages with FASB is that it focuses on giving a better picture of current period performance, so that historical performance could be a better example to investors as to how to go forward with their investments, or for managers with making decisions, they'll make it based on concrete stuff that they have in their financial statements. And it also allows companies flexibility in how they recognize items. So again, with the classification tests, it obviously is a lot more rigid, but with FASB, they are able to recognize assets pretty much how they please as long as they fall within FASB guidelines. However, a disadvantage and a major disadvantage of FASB standards is that there's still lack of uniformity in how financial assets are classified. So again, while the flexibility is still a great thing for companies to have, there aren't as many straightforward rules and certain things that have to be classified a certain way. You still have plenty of options, and those options create a lack of uniformity. And now I'll hand it over to Jack.
Thanks, Colin. And finally, we'll be talking about the potential impacts of IFRS 9 on the U.S. environment. From an investor standpoint, they're going to need to know the difference between FASB and IFRS 9. And we're mostly going to be looking at the difference in presentation between IFRS 9 regulations and JP Morgan and FASB with CECL regulations. And we're going to be going over Deutsche Bank, JP Morgan, and Brookfield Asset Management. If you go to the next slide here, Deutsche Bank is a multinational German company. This is from their 2019 10K, and it demonstrates the difference in the stages for the overview of financial assets that are subject to impairment. So as we've talked about earlier, the impairment baskets that IFRS 9 has to deal with compared to the CECL direct write-offs that the FASB has issued, which is on the next slide here. And JP Morgan, we chose to demonstrate this. They are another large international bank, but this is based in the US. And so as you can see in the picture to the right, they have the CECL adoption impact. And this just kind of demonstrates the how different the previous accounting standards were as we've transitioned more from an incurred expense model to an expected rate loss model. And so now if you go to the next slide with Brookfield Asset Management, Brookfield Asset Management is a Canadian company. We put them here to demonstrate the massive overhaul that these companies needed to change, and you could see it, how they needed to change their books for their financial assets when it comes to recognition of income, whether it's through comprehensive income or amortized cost basis, and even some of their borrowings as well needed to be changed. And so today, we went through the difference between IFRS 9, the tax impacts of IFRS 9, and the differences between IFRS 9 and CECL, and how that impairment is recognized on certain assets. So, thank you.